Well, there was consolidation where stocks marked time on global geopolitical uncertainties, but the bread turns negative. Metals and utilities are the big gainers, even as IT and FMCG drag.
Sources tell CNBC-TV18 that banks are likely to ask the RBI to relax its proposed hike in provisioning for project loans. A representative via the Indian Banks Association is likely in the coming weeks.
PEL jumps on a strong show in guidance, while IRFC perks up on a healthy income growth and fall in provisions. On the other hand, a decline in operating profit hurts City Union Bank, and a sharp bottom line dent weighs down Parag Milk.
Gold scales to a high of around $2,440 per ounce as hopes of a US rate cut this year rise, even as West Asia concerns over the Iranian president's death and poor health of the Saudi king fueled safe haven buying. Silver prices in India hit record highs.
Hello and welcome. You're watching us here on Halftime Report. What a stellar recovery we've seen from the lows. The Nifty now 22,542, up 40 points. A good move is what we've seen. The Nifty Bank on the verge of breaking into the green. And also the mid-cap index has been doing well. The advanced decline moving towards the advanced mark, even as more stocks are declining right now. So looking fairly good for our markets. We've seen some consolidation and recovered from the lows. I'm Manglam Malu, with me Ekta Batra. Hi Ekta.
Hi, Manglam. Well, yes, absolutely. No complaints coming into the markets or for the markets at this point in time. Just want to point out that even for the mid-cap index, which was sluggish at the start, is now leading from the front with a gain of around 0.2% at this point in time. If you compare it to, say, the Nifty, the Sensex, as well as the Bank Nifty. The advanced decline ratio, let's see how that turns as the day progresses. As of now, it's around 993 stocks advancing to around 1,385 stocks declining on the National Stock Exchange. So let's see whether that gap narrows as we progress. But overall, as of now, the markets seem to be consolidating, though they have seen a recovery. But let's talk about the first company on our radar. JB Chemicals is the first management on the show. It reported what was a healthy set of Q4 numbers. Margins improved year on year, while the CDMO business, which basically manufactures lozenges, crossed 100 crores for the first time in a fourth quarter of a fiscal. To discuss this and more, we have Nikhil Chopra, the CEO and whole-time director of JB Pharma, who's with us. Nikhil, hi, welcome to the show. Well, let's start with the domestic business. That was up around 22% in Q4. And the organic growth was, I think, around 13% if you adjusted for the Opthal business. Can you give us a sense in terms of how the domestic business did in terms of the acute and the chronic portfolio? And did it meet your expectations?
So, first of all, Ekta, good to be back on CNBC-TV18. And overall, it was a fair performance and overall outperforming in many aspects of revenue, EBITDA and profits, which I will talk in detail. And the volume growth in chronic part of the business is as high single digit. That is what 13% organic growth, what you shared. And acute part of the business, as overall market has been flat, we were also flat for acute part of the business. So chronic has been the savior, where the volume growth was high single digit. And we continue to focus on our chronic portfolio within that: cardiology, heart failure, hypertension, lipids. That is what we continue to do. And some parts of our acute business, like probiotics and pediatrics, they also showed around 5 to 6% growth for the quarter. That is where we stood overall from India perspective. Also happy to share that all our 5 brands, that is Nicardia, Silacar, Rentec, Metrogyl, Silacar T, are now in top 150. That is where we stand as a company. And particularly in cardiology business, which is $3 billion market, we are now 8th ranked company. And we have crossed a threshold of 1,000 crores revenue. And we are the fastest growing company in cardiology in the country in top 10.
Right. Nikhil, always a pleasure speaking with you. I remember, once you'd come down to our studio speaking about your plans for domestic and growth, etc. itself. Let's take that forward. You spoke about a revenue target for the next year. If you could give us a sense of how much of that will come from domestic, what proportion of that will come from exports, what's the growth target here? And the lozenges business, the milestone, 100 crore in a quarterly revenue, that was one of your targets as well. What's the target for FY25 here?
So, Mangalam, today 53% of revenue is coming from domestic, and 47% is our international business. And within that 47, 12% of revenue is coming from CDMO. So first, let me talk about domestic. 53% revenue comes from our domestic business, which probably a couple of years from here you should see going as high as 60%. And major focus, as I earlier was talking to Ekta, would be chronic part of the business, where we want to intend to take our contribution of chronic business on the higher side. So you should see 60% coming from India. That is what we want. That is what we are aspiring for. And when we look at what we are trying to do outside India, today 12% contribution, close to $50 million, is coming from CDMO business, where 70-80% of business happens in terms of lozenges. And also what both you and Ekta were talking, that we could cross the threshold of 100 crores for the quarter. You should see this 100 crores, what we have achieved, probably growing at mid-teens in second half of the year, because a lot of projects that we have put in place, a lot of new therapeutic segments, new geographies, new partners, that will see the daylight probably in H2, that is October onwards, FY24, where this 100 crore should grow at around mid-teens. That is where we stand.
Okay, all right. Well, you know, I wanted a brief comment from you with regards to margins, because you've always indicated that your guidance is 25 to 27%. You exited the year at around 26%. Q4 was 23%. Tell us, where are you going in FY25 when it comes to margins?
So, Ekta, I'm talking of operating margins, but let me first talk about the gross margins. Our gross margins for the year was 66%, and for the quarter was 65%. And this 65% gross margin for the quarter was because of 100 bips that we could see the dip because of the Opthel portfolio, where we could fetch around 35 crore revenue, where the margins are thin. So that happened for the current year, and 26-27% was our overall margins for the year. Going ahead, in spite of around close to 200 crore revenue, 190-200 crore revenue for the year for our Opthel business, where margins will continue to be thin for next 2 years, we should be able to generate 65% gross margin and between 26 to 28% EBITDA margins. That is what we would like to do. This will happen with some more entire work that we want to do in the world of shifting our portfolio towards chronic, better product mix, efficiency drive, and equally our South Africa business, where we would have seen growth being negative. But happy to share that today our margins are much better as compared to where we were 3 years ago when we started the journey. And from here onwards, you will see margins just going up for our South Africa business also, because the private contribution, which was 40% to overall revenue, is now as high as 70%. So South Africa business margin improvement, overall chronic mix, CDMO business contributing mid-teens growth will only help us to derive our EBITDA margins close to 26 to 28%.
All right, so you've upped your margin guidance at least on the other end from 27 to 28%. That's interesting. Or your entire range, which is now expected to be 26 to 28%. Just a quick question before I hand it over to Mangalam. KKR, what is the plan in terms of the stake that they have? Have you heard? I'm sure you're in talks, I'm sure you're in conversations with them about what their future plans are. Are we expecting an exit this year from KKR, or are they already in active talks with PEs?
So, Ekta, not that we comment on market speculations. Our capex for last year was 130 crores. Our capex for this year will be 100 crores. 20% will be growth capex. The new partnerships that we are putting in place for CDMO business. By the way, what I also wanted to share, that for the first time in history of JB Pharma, we have done BE filing of 10 products in our rest of the world emerging markets. This year also we'll be filing 10 more products. We have been filing 3 to 4 products, and we are filing that we have been doing for US market. So all the work that we continue to do to drive the business and take the margins high, create value for the stakeholders, that is the dialogue that we have with our partners. Otherwise, I don't think we can comment on any market speculation or rumors.
But we still haven't gotten your answer, because there was news that they were looking at people like Torrent Pharma and a bunch of others as well. Just wanted to know if the deal is anywhere close to fruition in this year, or maybe they'll hold on for a bit because of the guidance that you've given in terms of growth prospects that they have.
business continues to be as is, Mangalam. Last week only we had our meetings with our board members and with our KKR colleagues. And what I can talk is overall how we are what we are trying to do in tomorrow in inching up the business, inching up the EBITDA margins, creating value for the stakeholders, serving more and more number of patients. On these all speculations, as a policy, we don't comment.
Okay, all right, tight-lipped as of now. Let's see what the future holds. But Nikhil, thanks very much for joining in and speaking with us and giving us your perspective with regards to JB Pharma. In fact, the company has increased its margin guidance. I think that really stands out. 26 to 28% is what they expect going forward. We'll take a short break, but up next, we'll be speaking to Thangamile Jewelry to discuss their Q4 performance. Stay tuned.
Welcome back. It's a packed show that we have for you today. So back-to-back managements. Let's bring in the management of Thangamile Jewelry. The company reported a mixed set of fourth quarter numbers where the revenues grew for them, but we did see a decline in their margins at around 4.9%. And as a result of which, the net profit also fell by 9%. But that was the fourth quarter. We got a good update coming in from the company on Akshaya Tritiya as well. The highest ever sales, a 45% growth is what they saw. So let's talk about all of that and more. Mr. Lakshmanan, who's the CFO of the company, joins in. Thanks a lot for joining in, sir. Let's, talk about the top line first. You gave a guidance of 28% sort of growth in FY24. You've met that when it comes to your retail revenue. What's the outlook for FY25 when it comes to Akshaya Tritiya sales? And I mean, now that you have Akshaya Tritiya sales, what's the guidance?
Good afternoon, Mangalam. Thank you for the opportunity. As you said, the company had ended the financial year 23-24 at 3,827 crore rupees, an annual retail revenue growth of 28%. In terms of a volume for the last financial year, gold has performed a double-digit 11% growth, which is an exceptionally good one in terms of a volume, gold volume. And diamond has done a robust 39% year-on-year sales volume growth. As far as the current financial year 24-25 is concerned, it has started on a very strong note, very encouraging note. Akshaya Tritiya, the company has seen a year-on-year revenue growth of whopping 45%. In terms of gold sales volume for the Akshaya Tritiya, year-on-year growth rate is at 24%. Okay. The company is confident of repeating or even bettering the last year's performance in all parameters in this financial year 24-25. Things are bullish.
Okay, all right. Well, seems to be definitely bullish in terms of prices right now. Sir, you join us on a day where we have gold prices as, at record high, silver prices at 11-year highs. How does that change the dynamics for the business? Do you expect demand to probably get dented at some level simply because of the exponential rise that we've seen? Or do you expect volumes to probably sustain or be in line with your targets?
Yeah, good afternoon, Ekta. Let me start the conversation with a modified proverb. Gold is a proverbial friend indeed. Gold is a proverbial friend indeed. Gold price will continue to increase, and the people have, come to a realization stage that they have to going ahead with their buying as the wedding seasons and the festive seasons keep happening. They wait for some time, maybe a couple of months they wait, and they reconcile to themselves that the price is going to be, this is the way, and the purchases happen, and that is what is reflected in Thangamile Jewelry as well. As I said, the last year's gold sales volume is 11%. People continue to buy. They wait for some time, but they continue to buy to meet their wedding seasons and the festive seasons. So it does not try to have much impact in terms of our sales and the people's purchase sentiments.
All right. So people continue to buy despite gold prices being elevated. What about margins? The fourth quarter, we saw the margins slip below 5%. For the full year, it was 5.5%. You had said that you are looking at margins upwards of 6%. What exactly happened out there? And would you want to tell us more about it?
Yeah. The companies had ended the financial year 23-24 at an EBITDA margin of 5.39%, setting aside the gold price variation impact. I'm talking about the operational efficiencies. The EBITDA margin has improved by 80 basis points as compared to the earlier financial year 22-23. Earlier it was 4.59 and now 5.39. Okay, but for the Q4 position, the company is confident of taking this to 6% level in the financial year 24-25, and that had been demonstrated in the Q3, which we had been closer to 6% EBITDA. So the company has been taking all the possible efforts in order to take it to the 6% direction. Like let's take the SSS. SSS is at a robust 23.49%. Non-gold composition. There is a 25% revenue growth in terms of non-gold between the two financial years. And as far as the expenses are concerned, the company, as I had mentioned in my earlier CNBC discussion as well, that the company is incurring only to the relevantly required extent, be it the salary cost or the media cost or the administrative or establishment charges. So the company is definitely, earlier in the earlier years, the company used to have EBITDA in the levels of 4+%. Today, the company has come to closer to 5.5 at the annual level, and in one of the quarters, it has been demonstrated that we are closer to 6%. And with all these efforts, yes, the company is confident of taking it to 6% in this financial year 24-25.
Okay. Any impact on diamonds sales as well as prices because of lab-grown diamonds?
No, absolutely. Lab-grown diamond is not a concept as far as the Thangamai jewelry is concerned. Let's be very clear. We are talking only about the natural diamonds, and the mentioned 39% year-on-year growth is just about the natural diamonds. And then, as I had mentioned, Ekta, in my earlier discussion, that the company maintains a discipline of having diamond mailers, or it's called diamond dates, minimum one per quarter. In the last financial year, the Q4, we had even 2-3 diamond dates, and the youth appeal goes excellently well with the diamond, and the diamond continues to do wonders in the company. We don't have any issues regarding lab-grown diamond. It's a non-concept.
So I presume you are confident of taking the non-gold revenue up to 10% in FY25 and 12% in the long term, as you had earlier pointed out as well, right?
Absolutely, Mangalam. Absolutely.
So let's wrap it up then with your target on store addition, because 57 stores is where you're at the start of the previous year. You were at 53. The street would have liked you to, open more stores going forward as well. So what's your store addition target for this year?
Yeah, we started this financial year with 57 showrooms. One showroom has been opened during this 1.5 months time in the spiritual town of Rameshwaram in Tamil Nadu. So the present count is 58. The company is setting its foot in Chennai in the Q4 of FY 24-25, which will be the largest flagship showroom once open. And along with this, 7 more showrooms are going to be opened during this financial year, taking the total new showrooms count to by 9, increasing it by 9 for the financial year. And as I had mentioned in my earlier interviews with CNBC, the Thangamai jewelry is on a calculatively aggressive expansion path. Let me word those phrases very strongly, firmly. Calculatively aggressive. Wherever we want to open the showrooms or wherever we have been operating our showrooms, Thangamai jewelry continues to be dominant player number 1. Probably in some cases, it could be number 2.
Okay. All right. So we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Thangamai Jewelry. We'll take a short break, but more on the markets, and we'll put the focus on the F&O space and the cues from there. Stay tuned. We'll be back.
Staged a decent comeback as we speak. The Nifty is at the high point of trade. It's recovered a good 134 points from the day's low. We've seen a decent move on, the Nifty Bank as well, which is just about in the red right now, but has moved from the lows as well. On the other side, what's also happened is that the India VIX, which is elevated at around 6.5%, too has come off the highs. In the morning, the India VIX was closer to levels a little over 22. Now it's a little under 22 itself. For the Nifty Bank to sustain above the 20-day moving average is extremely crucial. Yes, it has seen a recovery. The Nifty is above both the 50 and the 20-day moving averages. The Nifty bank has to, for any other further move, cross the 20-day moving average, and that's extremely crucial. And for that to happen, the last hour will be important because we have some overlaps coming in from the other index as well. That's Fin Nifty, which is, playing out its weekly expiry today, closer to 21,500 right now, but it's the 21,500 call and the 21,400 puts, which are extremely active. Sustaining about 21,500 could lead to a last hour pop. For the Nifty itself, 22,500 call is still very active with a premium of 131 rupees, and the 22,500 put equally active. The premium on that has compressed as the market moved higher. Together, the premium on the 22,500 straddle is about 200 rupees. So the broader range that the street is playing for right now is 22,300 at the bottom level with 22,700 on the way up itself. Just watching out for a couple of stocks. A lot of long positions added on Balkrishna Industries. Stocks like PNB and Nalco may enter F&O ban, and SAIL may exit F&O ban, given the decline that we've seen in open interest on that counter as well.
Okay, so that's on the entire F&O space. Well, for the markets, just about flattish with the positive buys for the Nifty as well as for the mid-cap index. Mid-cap index has cooled off a tad bit. It's up around 89 odd points. It was up over 100 points some time ago. And the advanced decline ratio seems to have extended in favor of the decline. So let's see what that works out like. Maybe that graph should come up for you, and let's see whether there's any kind of marginal, probably just a marginal expansion which has taken place between the red and the green lines. Take a short break, but on the other side, Somani Ceramics will join in to discuss their Q4 performance. Stay tuned.
Adani Group stocks doing extremely well. Adani Ent has moved to the high point of trade, a recovery of nearly 4% from the lows, and the other one which is doing well is AB Fashion. But let's talk about Somani Ceramics. That's the stock which has actually rallied about 20% since its fourth quarter numbers. It was a good set of numbers coming in. In fact, the margins improved for the company. The net profit jumped by about 27%, and we did see an EBITDA growth of about 30% as well, on a high single-digit revenue growth as well. Abhishek Somani, who's the MD and CEO, joins in now. Thanks a lot, Abhishek, for joining in. Congratulations on what was a good set of numbers. You've spoken about, low double-digit growth for FY25, largely fueled by volume. So let's talk about the growth for FY25 itself. A sense of how H1 will pan out, how H2 will pan out, because H1 has the elections the first quarter. And FY25 volumes, what's the growth that you're penciling in?
So like we said, it's going to be low double-digit growth for FY25, and largely it's going to be fueled by volume. So that answers your second question, that mostly it will be a volume-led growth. Yes, you're very correct that the election is going to be, it's already hampering sales in the first 2 months, which is April and May. Hopefully after the elections, we should see a rebound. There's been a lot of labor which has gone back for voting. Plus, there's been extreme heat in the north coupled with that. So both put together is going to be a lackluster H1, basically because of Q1. So Q2 onwards, we do believe that it should have a rebound in growth. So fairly, very confident.
Okay. So net, would you have an outlook in terms of your entire FY25 volume outlook?
Yeah, like I said, it'll be double digits, but low double digits. Largely that growth will be volume led. So I would say a good 75-80% of that growth would come from volumes.
Okay. What are gas prices currently at? They were around 45 for every CBM in FY24. And that's lower as compared to the 59 rate that we saw in FY23. What is it currently, and what is the expectation on the trajectory?
Right. So we buy three kinds of gas. In the north, we have gas which is supplied from GAIL. So that's mostly on the RAS gas contract and also the Henry Hub. There, the prices are hovering around the 45, 46 rupees per standard cubic meter level. In Morbi, we get, which is in the west of India, in Gujarat, there we get gas from Gujarat Gas. And there again, it's pretty much the same as what we have in the north, which is at between the 45 and 44 rupee range. Somewhere there is the gas price. Currently, it is little higher. It's at about 47 rupees a standard cubic meter, but we do believe that it will be back to 45-ish standard cubic meter. And in South, which is our Andhra plant, that is where we are buying gas from at spot. There the prices are much higher. There our prices are currently at 50 rupees a standard cubic meter.
All right. So you expect them to stay range bound for this year so far?
Yes, we expect them to stay in range bound. And also I would like to, make it a point that we are also using a host of biofuels in our North plant. And also some of those fuels are being used in our South and our Gujarat plant. So that also averages out the gas prices further, because a lot of our spray dryers are running on these biofuels.
Yeah, that's important because, you have given us a 1 to 1.5% sort of improvement in margin sort of guidance in your conference call already. So I just wanted to know if there are future triggers beyond this 1.5% that you're talking about in FY25. And to that itself, a corollary would be the mix, because you have ceramics at 35%, PVT at 29%, and GVT at 36%. What's your ideal mix going forward?
GVT is going to go up. So I think ceramics and GVT will lead the race, and PVT is going to keep going down because that's more project item. And I think even in the projects, GVT is replacing a lot of the PVT. But I think the mix going forward, I mean, the ideal mix is as much as we can sell of the value added GVT. But I think the ideal mix currently, step by step, would be taking GVT up to the 40% level. Where it would basically eat into the PVT sales, not so much into the ceramic sales.
What's the difference in realizations between the two?
It's not a question of realization. It's a question of contribution. So in GVT, we do get better contribution. The reason for that is in GVT, we're able to do very different kinds of products and for different kinds of applications. PVT is kind of restricted to sizes and formats and also the design. So therefore, there's only a limited amount of value addition which one can do in PVT. It's nothing to do with PVT or GVT. It's just that GVT, we're able to do a lot more value addition, which as a technology, we're not able to do in PVT. Therefore, GVT gives us better contribution.
All right. Well, promoters have been buying stake continuously. I think you hold around 55% in the company right now. Any plans to increase stake further?
Currently, we did the buyback, and in that, a little bit of our stake went up, but no specific plans as of now to increase the stake.
No specific plans, but you've been a firm, contributor to increasing the promoter share of the company right from 51% in March 2020 at a much lower level. You've enjoyed the benefits of that as well, but as of now, no plans. We'll take that. And final question then, target share of revenue coming in from bathware and faucets, because you were targeting over 25% growth in this segment, which faced a bit of challenge last year.
I think last year the entire building material industry faced a challenge, and therefore, bathware was it's no exception. So if our main segment tiles had an issue, then bathware obviously had a little bit more of a concern. But going forward, again, the same logic applies. The base is very small, and we do believe that we should be able to grow at 20+% in the bathware segment. So
and you also,
then the whole building material sector has to start moving. Last year, the entire building material sector, which was in front of the wall, not so much behind the wall, which means the cement, steel, pipes did well last year. All the front of the wall items were struggling. So hopefully with the real estate sector really, booming right now, all the buildings which have been announced, all the projects which have been announced, that will come into completion, or rather start getting, the tiles being put. So I think that's the big positive for the industry.
So, you've increased your project sales as well from 20%, you're targeting 25 to 27% coming in. How does that impact your margins and working capital? Because projects obviously have a high working capital cycle and lower margins.
We've been selective to projects. We're about 6 to 7% in private projects and about 12% in government projects. So I think the private projects necessarily are going to go up because all the launches which have happened. I think after RERA, a lot of discipline is happening with the builders. So I don't think we will be in the same situation, in the same cycle as we were about 5-7 years ago with projects. So again, we're very careful as to which projects we're taking, which projects we are taking on board. So I don't think that would be a very large concern. Retail still remains to be a large focus. So I don't think that would be a major concern, because 3-4% project going up, some part of it would be government, some part of it would be private projects, and also a lot of commercial, which is, the organized retail, which is now also booming. So, the Zaras of the world coming up and they need tiles, the Marutis of the world, the Nexas of the world, all of that which is coming up. Everywhere it's going to be a tile consumption going up. So positive on all fronts.
Okay, all right. Definitely a lot of optimism there. We'll leave it on that note. Abhishek, thanks very much for joining in and speaking with us. So that's Somani Ceramics. The stock is down around 4.7%, has rallied significantly. Just want to point out stocks such as Hindustan Zinc are really the stocks of the day based on volume and price action. It's up around 12% at this point in time and is rallied now 117% this year already and up around 61% this month. We'll take a short break, but on the other side, we'll be talking to the management of Rainbow Children's Medicare to discuss their Q4 numbers. Stay tuned. Welcome back. Well, for the markets, it's absolutely flat at this point in time. So let's get talking about some other companies. Now, this is a hospital company that we're talking to, Rainbow Children's Medicare, the hospital major, which basically focuses on pediatric and women's health, reported what was a mixed set of numbers. The revenue jumped by around 8%, but the margins came in flat at 31%. It was maintained on a year-on-year basis. Occupancies dipped in the new hospitals, while the average revenue per occupied bed has risen on a consolidated basis. Ramesh Kancharla, who's the chairman and the MD of Rainbow Children's Medicare, joins in. Mr. Ramesh, thank you very much for joining in. I wanted to start by discussing whether, this is more of an industry-based question, where there are concerns that maybe revenues and margins for the hospital space has now peaked as compared to what we probably saw a year ago. There are concerns, for example, in Medanta's Lucknow operations, where the margins probably didn't stand up to what the street was expecting. And hospital companies are now reporting around single-digit growth and maybe some amount of margin pressure as well. Is that the case? What is taking place in the industry as a whole, if you had to share with us a bird's eye view?
I think that we work slightly differently from the industry because we are purely children's hospital, and we always have a kind of the seasonal variations. We do not do much of government business, which is kind of a low-hanging fruits. So, you're right. As a whole in industry, what we see is that last year has been a fairly quiet year, including us. See, the cyclical trends we do see in the hospital industry. When you have kind of 3-4 years of run and you suddenly see the kind of a little bit of flattish line. The last year largely been kind of one is a healthy year, and post-COVID, whatever problems have been kind of settled, fairly healthy year. And when it comes to us, that last year has been, when we look at our the revenues, the quarter-on-quarter revenues, the Q2 and Q3 are usually the very strong quarters for us. They're usually kind of a 6% uptick in occupancies as well as revenues in Q2, Q3, which hasn't happened. So that's a flat year. All through the year is a similar revenues. That's because of the seasonal variations and seasonal business, which accounts for that kind of business, which was not there much. So what we have kind of seen is that our regular business, which is kind of our tertiary care and quaternary care, is kind of well preserved, and the obstetrics has done well. And whatever we do in the seasonal illnesses, like pneumonias or other infection-related illnesses, and to an extent some degree of intensive care services, have taken a kind of a hit. So, which is why our occupancy has been down. That's the kind of a year what we have gone through it last year. That's why the ARPP also, ARPOB also, you have seen little slightly higher. It is a relative compared to the kind of, because when you have a lower seasonal business, your ARPOB will tend to go up a bit.
Okay. So I just wanted to, drill down further on the occupancies in the new hospitals. I think you have around 567 beds which are operational there. It's come down to around 32% in terms of occupancy in Q4. FY24, you did 33% versus 41.6%. Is that because there's new capacity which has come on board and that's still to take off?
Yeah, we have added about 3 hospitals and an additional block. All of them have come in the Q4. Almost 280 beds have come in the last quarter. So that has kind of depressed significantly of the occupancy of new hospitals. So they all come in the kind of February, January to March.
So these new capacities which you have coming on board going forward, I mean, which have already come on board, what is the occupancy and the RPOP that we can expect on both of them, on the new capacities which have come on board? And hence, net, what would the consolidated metrics be for the new hospitals going into FY25?
I think they're fairly, it's quite early kind of to assume the kind of RPOPs of these new hospitals, because one is they're all the spokes, Hyderabad, Bangalore and Chennai, the spoke hospitals. Normally we expect about a break even to take place in about 12 to 15 months time. This is what our track record shows. So I would expect that to happen. In terms of about occupancies, about 35 to 40% occupancy, we should kind of solve all the problems in terms of break even of this hospital and also look fairly healthy towards the end of the year.
All right. Let's talk a little about the addition of rooms. You had guided for during the IPO. I remember that you would go to 1,000 beds. You've done about 435 of that. By when do you hit the 1,000-bed target? What's the update on Gurgaon and Coimbatore project?
Yeah. So, Mangalam, Gurgaon is taking a little longer time to get our approval, the conveyancing, all those things from the government. So, which we have got it now, and we're going to register it in a couple of weeks' time. And probably the groundbreaking happens in 3 to 4 months' time. So, we expect it kind of 1,000 beds to come in by 27, the 2027.
All right. And the cash that you have on your books, closer to 500 crores, is that correct?
500 plus crores on cash in the books. So we wouldn't probably need any further inflow of cash. Balance sheets are fairly strong enough to support all our expansions.
How do you split it between capex and acquisitions?
Absolutely.
How? As in, just trying to figure out how much is.
And the capex is kind of, the regular capex is not going to be kind of probably a next 3-4 years horizon is going to be less than 200 crores, and annually we generate about 200 crores add to the balance sheet. So put together, I think with the existing cash on the balance sheet, we will have probably 1,000 crores for the maintenance capex as well as the new capex.
Okay. I just wanted to touch base on your IVF hospitals. You've launched it now in 11 hospitals. No, you've launched it additionally in 8 hospitals. Now you have operating IVF in 11 hospitals. How is that doing? How much is it generating in terms of revenue and business for you? Can you share some numbers, and how much do you expect it to probably grow and be a percentage of sales?
Okay. So we had till only 3 IVF centers in our existing hospitals now. All these the 7-8 IVF facilities we added within the existing facilities in the last 3-4 months' time. They were quite expected that we would probably do about 1,800 to 2,000 cycles by end of the year. This is what forecast. We'll have to see how we could kind of achieve it.
Expecting, how much did you do in the previous fiscal?
I think it's about 500 cycles, which was the kind of run rate earlier.
Okay, so you're expecting a significant up move there, and margins. So what is your guidance going into FY25? What will you sustain your margins at?
We kind of we expect about 15 to 18% growth of current year, because whatever the capacity additions we have done it, we don't have much of a kind of a capacity addition coming in the next 3 quarters. So we have worked towards, we will work towards kind of building the business this year. Probably 15 to 18% of the growth, what I would expect it this year, with the new addition of beds and also existing growing hospitals. I think the margins, we'll have to look at how these new hospitals are going to kind of pan out. So likely, I think we will probably be there pre-Ind AS around 24, 25. This is what our expectation is. But we'll have to see the new hospitals, how they're going to kind of shape up.
All right, so 15 to 18% top line growth with 24% sort of margins is what you're guiding for as new hospitals come on stream. 2027 is the year when you add about 1,000 hospitals, 1,000 beds since the time you've guided us from your IPO. Thank you so much for joining in, Dr. Kancharla. We'll speak to you in the middle of the quarter, perhaps after your next quarter results as well. Take a short break, come back. On the other side, we bring in all things commodities. Manisha Gupta joins in with Chirag Thakkar, who's the director at the Amrapali Group.
Welcome back, and joining us on the show now is Chirag Thakkar. He's Director Amrapali Group. Chirag, hi, good to have you. And what a start to this week yet again when we are looking at all-time highs in silver prices in the Indian market. I mean, I remember from the beginning of this year, we've been talking about a possibility of ₹1 lakh per kilo in case of silver. I mean, that looks very, very close now. Chirag, you're on mute.
I'm sorry. So yeah, hi, Manisha. So we have been anticipating this move since early start of the year, and if you could possibly see, there is still a disparity in the market. But if you make a costing sheet, and if you see a landing cost when you import the silver into the Indian market, we already touched the 100K mark, and we're still at a disparity here at this prices at these levels. Once you see this disparity gone, we would see this 100K prices maybe next couple of weeks. We could see these prices coming into the play.
All right. Chirag, when you say disparity, would you mean that since the volatility is very high, there are basically no buyers in the market right now, is the reason that the Indian markets are selling at a discount? So what is that discount really?
So as of now, it is at 4,000 rupees of a discount per kg. And if you see, we are already at 95, 96,000. We already touched in MCX of the exchange. But if you see, if I go today in the market and say I need to buy this metal at a discount of this rate, it is highly impossible to get any kind of a quantity at this discounted rate. It is just that the quote is of a discount, but when you actually go on the ground market and try to buy at those levels, you're not going to get hands on this physical metal at these levels.
And what is the reason for that, Chirag? Because if you look at the imports, we've seen a decent number of imports happen in the first 4 months of this year.
So first quarter, we see a very larger import coming in. We are trading at $23, $25. I think Indian prices moved very sharply on the upside. At the same time, India was able to procure that metal, what they required for their next 3 months, 4 months, whether it be investor, whether it be industrial makers of the silver. And also, if you see the silver manufacturers, they're already sitting on their stock, right? So on the first quarter, we imported a very nice numbers. At the same time, as we see a sharp move upside, we are unable to see those import numbers at the current month and the last month as well.
Chirag, what is the sense in the buying right now? I mean, going forward, it's going to be wedding season very soon. It's going to be the festival season. Do you see people coming out and buying at these levels? And if yes, then in what form? Because silver ETF is something that also seems to be getting bought at a stronger number right now. So do you think physical will stand tall as it always has?
I'm sure. See, Manisha, there is always a shift in a roller coaster ride of a silver physical demand. If you see last 2 years, we have obviously observed and seen that there is 2 months of time when there is a huge buying of physical demand. At the same time, if you talk about the ETFs, there's a lot of perception wherein equity investors have shifted some of their allocation portfolio towards the ETF. We have seen growing ETF AUMs drastically from last 6 months, and we keep seeing that. At the same time, I don't see any lockback in the physical demand down the line coming in the season as well. If the prices are sustained at the same levels, at the same time, if it corrects, I'm sure there'll be huge buying coming in, and that will be the opportunity for an investor or a stockholder as a manufacturer as well. It will be the right time for them to come in at that levels when it gets corrected. And then obviously we'll be seeing these prices going back up again.
Chirag, while of course physical silver, as you said, will continue to be stronger, silver ETF seems to be picking up. Digital silver seems to be doing well. So would you say investors really have avenues, more than one now, to own silver?
When we compare ETF and digital silver, so ETF, there are some points wherein you can't exit after 3:30 when the market closes. But when you talk about the digital platforms who's offering silver on the digital format, they can buy, lock the prices, they can sell the prices 24/7. At the same time, even if they want a physical delivery of a small grammage, starting from 1 gram to 1,000 grams, it's easier for them to do so. So I believe on our platform, always we have seen that there's a more millennials coming into the picture. They are buying the silvers in a very small manner, in the manner of SIP as well. There's a lot of buying we have seen. At the same time, we have also seen a physical delivery of silver. So I think there is going to be a very big penetration into the market wherein a new small investor is coming in, doing SIP as it has been done in the equity markets, in the mutual funds. And I think that is a right way of doing it, wherein you can lock the prices of this big movement which is happening into the market. And at every price, at every moment, you can lock your price.
So Chirag, what is the smallest amount that people do buy silver with? I mean, I do understand when the gold, digital gold came in, 100 rupees is something that people were buying it as. So tokenization in that sense has really done wonders. So when it comes to silver, what is the lowest ticket size here? That's part one of my question. And part two is, now where do you see the silver prices headed?
All right. So lowest ticket size is as low as 100 rupees. And it has been in the multiple of 100 rupees. And we also seen major HNI clients also coming in and holding the silver metal, as in the format of the silver. Let's say if you want to buy a 30 kg bar from the market, it's so tough for an investor to maintain that 30 kg bar, keep it in their house, keep it in the locker. So they are preferring to have it when they are having a bigger exposure on the silver market, on the silver prices, in the silver weightage. They prefer to buy it digitally. This is the answer to your first questions. Coming to the prices, we have seen a roller coaster rides since the last 2 days. We have seen touching 32.75, coming back to 31, right now trading at around 31.65. But I think now it will be a consolidation mode, because we don't see, as soon as we don't see the metal going above the 32.5, 32.75 range. And I think it will correct till 30.5 will be a right level to come in to a play to buy. But higher side, if there is a favoring data coming out of the US market, wherein the CPI data actually moved the gold and silver prices higher last week. So we'll be seeing some data coming this week as well. If that is favoring to the precious metal markets, I'm sure it is still not at a overbought situation, but we could see those prices to go till it is a overbought situation, and then we can see a correction from there.
All right, so on the screens, we've done 95,000 rupees a kilo for silver, but in the physical markets, add the duty and the GST to it, lakh rupees a kilo is already a price that has been traded on. But as Chirag says, some profit taking from here could come in, and people will start buying once the price is stabilized going forward from here. Chirag, as always, thank you so much for joining us. And with that, it's a wrap on Halftime Report, but Business Lunch will take all the action forward.